We routinely get questions from clients and listeners. This week, we're talking about what's in the mailbag. Join us and subscribe and like before you do.
Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president and financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Welcome, everyone, to another episode of Something More with Chris Boyd. I'm here with Jeff Perry and Russ Ball. We are all of the AMR team and very happy to have you joining us. Remember, you can find us not only by audio podcast on Spotify and Apple and wherever you like to listen to podcasts, but you can also find us on YouTube for a video version, as well as at Something More with Chris Boyd. Please do follow us. We like to have you catch every episode you can. All right, today we're talking about the mailbag. And I love these because there's a lot we're going to cover, lots of different topics. But it feels like from time to time, we have different things emerging where questions kind of are coming up maybe from different people, but with similar themes, And I thought, well, this is a good time to revisit some of those recurring kinds of questions that keep coming up. And there's a variety. The first one I'm going to reference is the question of when to right size, when to sell, when to right size your portfolio. We've had a couple of different instances where someone's been thinking about making a change in their portfolio design and got a little bit hesitant because, markets aren't at the peak they were at. We had someone selling gold. They had an oversized position in precious metals, gold and silver. And they were like, look at all this change that's been happening. Maybe it's too late. Maybe I missed my moment. And you look at it, they're way above where they started. The gold and silver was something that a client did in a self-directed account where they wanted to have a substantial position in these precious metals, more than we really would have encouraged them to have. But it's worked out fabulously well for them. And, then the market takes a tumble on some of these precious metals, the pricing, and it's still hugely up, big returns, far greater than they would have had in their stock in that period of time, this short period of time. Don't wait. Take the win. Call it a day. Lock in your gains. I had someone else thinking about right-sizing their retirement account and feeling like it had grown into more equity. Their needs have changed, thinking differently. Why wait? Oh, the market's not at its peak. It was up more a couple of weeks ago.
What a problem to have. This is horrible.
Exactly.
This is horrible.
Should I dollar cost average or should I just take the win? These are tough questions, and there's no crystal ball, of course, to know what's the right answer in advance. But I think, with some perspective, like in terms of the markets, yes, we're not at our peaks, but we're still at very good levels. It's perfect time to rebalance. It's a perfect time to take the win, recalculate where you want to be. If you're trying to reduce risk, go ahead and do that, but Jeff, you are going to comment.
Well, people, it's natural, right? First of all, it's natural in any part of your life. You want to go out on the very top. You want to, whatever that means to you. But this just comes down to the other discussions we've had about market timing when you're more focused on getting in at the bottom, out at the top, like perfectly. And that is very rare to happen. You might get lucky, you might not. But you have to look at, why did I buy this asset? Why do I hold this allocation? What was my goals with it? What do I think the valuation is today, whether it be an individual commodity or stock, or whether it be, the market in general.
Yeah.
And there's lots of things that I use, like little tests that I use to when I'm thinking about these things. One of those things is, when I bought this, what was my expectation? What was my hope? Right. And I also ask myself, is this asset, this stock, whatever, likely to go up 10% from here or down 10% from here? And that kind of helps me focus in on the question and not get carried away with, well, it was at 100. It was at 100 last month. It's only at 98 today.
Yeah.
Maybe I should wait for it to go up and break through that 100, then I'll sell it. So, and not. I think the hardest decision when you're talking about investing, I know you're talking about allocation as well, but you're talking about like investing in an individual stock, asset, or sector, is when to sell it. It really is the difficult.
It really is the most difficult part of investing is when it comes to this decision of not just what to buy and when to buy, but when you own something, when to sell.
And that can be up or down. I mean, you could invest in something, either sector or asset or commodity. You pick it.
Yeah.
With high hopes, and maybe you did research and the price is down, and so that's an equally, or maybe even harder. It's these decisions on when to sell are difficult, and they're really better done with the advice of someone who's got learned experience and counsel, and put it in the context of the a plan, not just an individual decision and what emotion is going through you today.
Yeah, I mean, at the same time, it's difficult. Even though this is what we do day in and day out, it's like trying to figure out any kind of timing in the market just is not a proven strategy. It has probably never worked. And same goes for, if you're getting close to retirement, and this happens a lot where a lot of clients will have a stock heavy portfolio coming.
Yeah, good point.
Near to retirement. And, let's say they're about to retire, they start working with us. We encourage a reduction in risk, which usually means less exposure to stocks. And then the market keeps doing well. And they're like, well, if I had just stayed in stocks, I would have done great. I would have had even more. But you could,
Yeah, when it comes to investing, there's two sides of the same coin, and it's risk and return, right?
Yeah.
So yes, but what's the appropriate amount of risk? What's the needed level of return? Oftentimes, when we put this into the context of the financial plan, we recognize maybe we don't need to be as concerned about, beating the index kind of returns, because the level of risk we'd like to have is lower, and the level of performance we need to achieve our objectives may not mandate that kind of a level of performance. It depends on the circumstance, of course.
Chris, one more
quick
just thing that
I just want to, and something Russ said, we make tactical decisions all the time with our portfolios in the way we invest. But that's different from timing the market, which is to say all in, all out type of decisions. So just wanted to clarify that a little bit. Go ahead, Jeff.
You made an excellent, well, you framed it in the point of a question, but about should I dollar cost averages, because these decisions are not all or nothing. If you have the benefit of having a nice gain in an individual stock, sector, mutual fund, whatever, and you're getting a little nervous about it and you want to reduce that, you don't have to sell at all.
Yeah.
You can start selling, you can start selling X amount per month. And if the price goes down below where you think is fair value, you can pause that. So you don't have to do all or nothing.
Yeah, it's a good point. It's a good point. I think it's challenging to know these decisions. My thought is, if you are near a high in the markets, that's good enough, right? It doesn't have to be at the high to consider scaling back risk. But then you have that issue of, well, what if Things just keep going higher, like you're talking about. That's when people feel like they might prefer. So I think then it's a question of balancing which is a greater concern to you. Would it be a greater concern that I lost value, erosion of value because of a market decline? Or would I be more put off by the fact that I missed out on upside because the market continued to run? Which gives you greater discomfort? If the answer is I'd be more annoyed that I missed out, then okay, do it slowly, do it gradually. If the answer is I'd be more annoyed if I saw my values decline dramatically, do it sooner. You know what I mean? I think that's how you kind of get to that question. Yeah, go ahead.
And one way we put that in context with the financial plan is we say, how would you feel about losing 20% of your portfolio value? So if there was a 20% decline in the market, not everyone is 100% stock, but just for a hypothetical, it's possible you could lose 20%. And if that's $1 million portfolio, that's $200,000. How does that make you feel? Are you going to be able to stomach that? Is that going to make you decide you want to pull out of the stock market entirely and go into cash?
Right.
I think it's important to think in terms
of
numbers.
In dollar values. Yeah,
exactly.
Your numbers. Yeah,
I'm joking here, but I can take a 20% loss, but I can't take a $200,000 loss.
Right. You know what I mean? I think that is exactly it. People, it's abstract when it's a percentage. A dollar value is more specific. It's more palatable in terms of you can sense, okay, what's that impact? Similarly, we were talking about gold and silver earlier, and the client who was trying to decide whether to take some money off the table. We also had a similar story where someone said, "Oh, gold's gotten a better price. I'm going to buy," and we were like, "Oh, great!" Thinking they had a little sandbox account, and in their case, they were just going to do a modest investment, maybe $10,000 or something,
something speculative, right?
Yeah. And they said, no, I want to put a third of my money in gold. We're like, what? Let's put the brakes on that. Gold, people tend to think of gold as a store of value that doesn't go down. And of course it's had, a nice, run up recently, but gold is volatile. Think of it, it's commodity, but think of it in the way you think of stock in terms of the kind of volatility and risk that you might experience. And what drives its price movements is less defined than what drives equity stock price movements. There are things we can point to when we think about what drives stock prices. Oftentimes it's related to earnings and profitability and some of these measures that we can look at. What happens with precious metals is really, particularly gold, is more driven by sentiment, oftentimes driven by what's happening with the dollar. So it's harder to get your hands around what's going to move that price. And so anyway, Brian's, I think, recently done an article on this, or not recently, but in the past, he's talked about this issue and how to think about this. So I'd encourage people to reference that. I think it's on our webpage as well. And then, which you can go to wealthenhancement.com/AMR as an easy way to get there.
Chris, I'll put a link in the show notes to
that. Good. Okay. Thanks. Well, in any case, let's also turn to some other things that were questions people were having. And Jeff, you mentioned with some clients we were talking to the idea of tax concerns. As I am in retirement, maybe you want to set things up a little bit, like that notion of whether I wait for my RMDs or not. And why,
sure. Yep. So as we know, under the recent legislation that came out of Washington over the past few years, the RMD, the required minimum distribution age, has been bouncing up.
Yep.
So, depending on how old you are, it could be up to age 75 that you have to take them. And so for the individuals, which I think is probably our example here that we've got the questions from, who don't need the RMD, they don't need a withdrawal today. So they don't need to take it. And they're starting to...
They're not even yet at their RMD age.
That's correct.
Yeah.
And so they're thinking about, well, so when I'm 73, 75, my RMD is now going to be higher than it might have been because the schedule, if you will, is shorter for someone's life expectancy. And so they're starting to do some math and say, so if my RMD is X when I'm 73, 75, that's a lot more money than I need. And I have a pension, I have this, I have that. Is that RMD going to push me into a higher tax bracket? So should I consider taking withdrawals now while I'm in this current tax bracket, so I'm not pushed into a higher tax bracket, and pay some taxes now at a lower rate, even though I don't need the money? And like most of our answers, it depends.
It depends. Well, I think there's a good point that, when you think about where we are today, just in the wake of the One Big Beautiful Bill Act, there's some recent tax legislation that is advantageous for at least a window of a few years, where there is a good argument to be thinking about taking more taxable income because you have more, particularly for people in a certain age range, that senior citizen, the 65 up, you get some extra sweetener in your tax incentives, this effort to offset Social Security income a little bit through some tax treatment. And not all this is going to be around forever, at least the way it's structured right now.
Right.
So that's one good argument for either taking the money, right, taking the income. If you don't need it, maybe you do a Roth conversion.
Sure.
Let it sit in a tax-free setting for a while, potentially growing tax-free, which would be appealing. Maybe if you really don't need the money, you also could entertain whether you want to use some charitable giving. But if you're 70 and a half or older, you have the opportunity for a qualified charitable distribution. You mentioned that when we were talking off camera, Jeff.
Right.
The idea that there could be some advantage to that as well. But so there are a variety, again, very specific. But if I have income that I don't need the money, what do I do? Well, there's some planning opportunity there.
Right.
Are you going to comment on that, Russ?
Yeah, well, it made me think of something I've been reading recently where, the market's done so well the last few years, and people have been doing this Roth conversion strategy. And a Roth conversion they think is a reasonable amount. They would pay the tax on it. And then come the end of the year, their portfolio is even higher. So it kind of offsets the conversion that they did in the first place, which is a good problem to have.
Yeah.
It just kind of goes to the point. So if you don't need that money, putting it into a Roth account is definitely a good way to grow that wealth without having the necessity for taking RMDs down the road. Again, that's not just for the people who are of RMD age. It's also for their beneficiaries. So, when people inherit an IRA, there's this 10-year rule where they have to take the funds out of the IRA and they're taxed on it as income. So with a Roth IRA, it doesn't apply the same way. So with Roth IRA, people still have a 10-year rule. So the beneficiaries would still have to take the money out within 10 years, but they're not taxed on that.
Yeah, one client I'm working with is in a relatively low tax bracket with his current income, and he's not of RMD age. So he is taking the delta between his income and filling the bracket, as you'd say, and then converting that funds, as you indicated, Russ, to a Roth IRA. Yeah, it's still a relatively lower tax bracket than he will have when he's doing his RMDs and the market is high, which is also a motivator for him to say, let's take some money off of this and put it in my Roth, maybe a little less aggressively invested. And so that all makes sense.
Typically, what we'll see when we're looking at Roth conversions in the financial plan is, there's these income, like peak earning years for people as they approach retirement, and the tax brackets are pretty high up there. And then between retirement, let's say 67, and RMD age, it drops way down. And you're at probably one of the lower tax rates, maybe before you start taking Social Security. So there's this window. And then at RMD age, the tax brackets go way up again, and all the way until the end of life. And so spreading that tax burden out over time and smoothing it out is definitely appealing, for not just for tax picture overall, but also people get really hung up on the IRMAA brackets, and people getting into higher and higher Medicare premiums. So
nothing makes people crazier
No.
than those IRMAA. It just makes them nuts. It's like
they don't see it coming at all.
Yeah,
it's really one of the under discussed risks out there to taking large amounts of money.
That IRMAA we're talking about is the calculation for how much premium you pay on your Medicare premiums. The tax, the way it's essentially a tax. We'll call it a tax. They think they call it a surcharge, but in any case, you the more income you have 2 years prior, the more Medicare premiums you pay, and there's different brackets for that as well.
Yeah.
All right. In any case, so that's a topic that's come up. This thinking a little bit tax planning, a little strategy about what's the future looking like. Maybe I should take some of my money before I have to when it comes to my big IRA. In some of that, you also mentioned, Jeff, people are need to keep revisiting their estate plan.
Geez, it seems like we were on a streak of them recently with clients, or I won't say almost, but many clients that we met with when we discuss, what's new in your life and how are things going, etc. And we typically ask if they've read their estate plan recently, or several of them indicated they were in the contemplation stage of changing things because of diverse and new family conditions, either new people in, or not people that shouldn't be in it are in it, or relationships, divorces, living with someone that you're not your spouse, all these like unique issues that come up. And it's on a lot of people's to-do list, when you ask them the question, but it's not done.
I had the exact same conversation yesterday with one of my good friends, saying, I need to update things. And honestly, I'm thinking the same for myself. It's like, oh, geez, things have changed. The kids are a little bit older. Right. Maybe we're at a different stage of life that what we thought was the appropriate plan before, a few years back suddenly is like, maybe that's not applicable the way it used to be. How do we want to alter our structure? And in addition, there's all kinds of legislative changes that have happened.
Lots of legislative changes, yeah.
That also is something that's relevant to be planning around. As so there's just a variety of things that can happen. We had clients recently we were talking with who had different health concerns, different health needs, and that's another variable that impacts maybe how should they address their estate plan, what thoughts go into that. So yeah, that's it's its own show, certainly, but just as a reminder, it's a good time of year. Again, we're still in the new year. Start getting around to those things. You're doing your tax return, to review your estate plan as well.
Absolutely. And it's not just, we say estate plan and people think, all right, where's my stuff going? Yeah. It could be like, who's your healthcare proxy? Who's your power of attorney? Et cetera. And so if you have somebody new in your life, that is relevant to your estate plan, or if somebody was in your estate plan, isn't here anymore, if you've moved, if your health has changed, you said, Chris, I mean, all these things are good reasons to.
Can be a lot of consideration and new laws,
And new laws, because the courts are going to interpret it as it is written. So, even if you're divorced and think, well, my ex-wife is no longer my estate plan because we're divorced, you'd be wrong.
That's a good point. That made me think of beneficiaries too, right? Like old 401k plans.
Good point.
That's usually a big
this
one.
comes up much more than you would think.
Mm-hmm.
Yeah, where people may forget that they had a 401k or 403b somewhere sitting out there. It might have the wrong beneficiary on there, whether it was before someone got married or after they got divorced, something like that.
Kristen was just talking about this a week or two ago, where she was talking with one of our clients and said, well, you might not want your ex-husband to be your beneficiary still. Should we update this, do you think? Like, yes, like, let's get that done. So things like that. You guys had an interesting question come up as well about annuity income. When do you choose to have annuity for income? When does it make sense? And I think this could even be its own show as well, but in a short amount of time, I think we can cover at least a couple of quick thoughts as it relates to this. Russ, do you want to set us up? This has come up a little bit, this question.
Yeah. So, whether it be for people who have existing annuities out there that they picked up over the years, or for people who are more averse to market risk, the thought of, having some consistent income come from an investment where there's a lump sum put up or some amount put in over a few years, that could have some appeal, right?
Yeah.
So it's just, it's been coming up a little more recently with more clients. I think typically annuities wouldn't be our favored option
vehicle,
right?
Yeah.
Not that they're bad for every circumstance, but
lots of discussion about this recently with a ruling with another advisor who had some missteps and misappropriate or failure to disclose at the very least.
Yeah, I think annuities have a bad rap for reasons, but also because this case regionally related to Massachusetts was highlighted some of the shenanigans or lack of disclosure that happens on the sale of these products. And so I think that many people, especially advisors, have this negative perception of them.
Yeah, certainly a hesitancy because of the costs built into them, sales charges, fee expenses, et cetera, et cetera. And hidden charges sometimes if it's not a prospectus sold product. There's who knows what some of the costs are.
And I think the big one that we've seen recently, at least some that have been in the news, is these redemption fees.
Surrender charges.
Surrender charges is a better term, right?
Yeah.
People either don't know about it
for like 10 and 12 years.
Right.
Wow. Gosh. Can you imagine as a 70-year-old, 70-something-year-old, buying a product that has a 12-year surrender charge and then having it be replaced with another one? I mean, it's crazy to think that that happens. But in any case, don't get me started on that, right? But there are times when you can see someone has an annuity or may have features of an annuity that you say, all right, as much as I might not have chosen to acquire this, maybe there's some virtues we can benefit from.
Right.
A guaranteed income level on some of your wealth, right? So there are some advisors who feel very strongly about the use of annuities in a favorable way with the intention of having a minimum amount of income, Social Security and pension or annuity income to cover your guaranteed expenses, your non-discretionary costs. And there's an argument for that. It's not one I am as drawn to because I think it depends on when you're buying the annuity income that can be more or less appealing. But in any case, some products, as we've seen, have the ability to give an attractive income stream that's guaranteed for life. And for people who want at least some level of, I would think of this as most appropriate for the most conservative investor type personality that's, the least comfortable with risk, to have this kind of absolute as a base so that it frees them up to say, okay, now I can take some risk with this other portion of my wealth because I know I've got my bases covered for some of the essentials. And then we often see when people have an existing annuity, all kinds of costs built into it. That is to say, tax cost, right? It's deferred taxation. Not necessarily the fund fee or the embedded costs of the annuity, but just the idea that there's deferred taxes. That can also be a good time, a good use, a good reason to consider making use of an immediate annuity, because it spreads that tax burden in a different way. If I take the money out as a withdrawal, I have to pay all the taxable part first. If I take it out in an annuity income, depending on the way it's structured, but a truly annuitized income stream, I get to take a portion of the principal and a portion of the earnings to spread that tax burden out over time.
Yeah, let me put my retired lawyer hat on for 1 second.
Yeah.
Annuities can also be part of an estate plan, long-term care solution. So it really depends on, do you have heirs that you want to save for also? I mean, is your part of your whole financial plan legacy planning? Or do you have no heirs that you're trying to just support yourself with no need or desire to have any money left over? So,
yeah.
Some products are sold and some products are bought.
Mhm.
Historically, annuity products have been sold to, by entities that sell annuity products. So, the best advice, if you're thinking of that it might be part of a financial plan for you, or someone's trying to sell it to you, the best advice is to get advice from somebody who doesn't have a stake in selling the annuity to you, like a fiduciary, a financial advisor who's not compensated other than by the advice that they give you and the assets that they manage. So, like, before you take the leap, because the sales pitch is going to sound great, just like a timeshare, it's going to sound great at the moment. Get some third-party advice before you take the leap, because it can be a devastating decision if you need that money.
All right, good points, all of them. Anything to add to wrap us up, Russ?
On that topic,
yeah.
I think there's more and more research out there, from people like Christine Benz and others, thought leaders in that space, where they say, kind of to your point, Chris, if you can cover a base level of expenses with some kind of income, whether it be from an annuity or from a fixed income part of a portfolio, that frees up the feeling like people will be able to spend more of their assets and not leave too much on the table down the road. So just some interesting, developments.
And Jeff, you made a good point I hadn't thought to mention about sometimes annuities have great long-term care features that it could be an effective way to help you navigate those expenses at some point in time. So,
that's relatively new. So,
yeah, good point. So anyway, big picture, we covered a lot of different topics in today's episode, but the big picture is how you navigate these kinds of issues, whatever they may be, whether it's your allocation, whether it's big bets when it comes to overweight positions and certain kinds of investments, whether it comes to use of annuities or your estate plan. All this fits into thinking about your financial plan and the forecasts that those can help you to navigate the decisions that you face at any stage in your financial journey. So take the time to get your financial life in order with the building block of a good financial plan. Work with a fiduciary And if we can be a resource to you in that effort, certainly give us a call. With that in mind, thanks for being with us for another episode of Something More with Chris Boyd. Until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll-free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.